So imagine growing your company's revenue by like 53% in a single year.
Right.
You generate over $1.5 billion in cash profit.
Which is insane.
It is. It's massive. And then you step up to a microphone to tell your investors, well, you basically say, we are disappointed, we fell short.
Yeah.
So, welcome to today's Talk Tickers Deep Dive.
Thanks for having me.
Our mission here is always the same, right? We take these highly technical, jargon-heavy earnings calls, translate them for you, the retail investor, and usually we try to give you the data-forward, actionable bottom line in under 5 minutes.
Usually, yeah.
Usually. But today we have to spend this entire deep dive unpacking a really weird paradox. We're looking at the Applovin Corporation, ticker symbol APP. This is their Q2 2026 earnings call.
And it's a fascinating one.
It really is. Okay, let's unpack this. How does a company grow revenue by 53% and still call it a disappointment?
Right, because, it defies all standard business logic.
Any traditional enterprise would be, throwing a parade for those metrics.
Absolutely. They'd be popping champagne. But in the realm of algorithmic advertising, and specifically with Applovin, you have to remember that this is a cash-generating machine.
Right.
But on Wall Street, timing is everything. The market demands this uninterrupted, perfectly scheduled, exponential growth. So a 2-week delay in a software update.
Even in a quarter that generated almost $2 billion.
Exactly. Even then, that tiny delay triggers a completely different narrative.
Which is exactly why we're putting on our Talk Tickers hats today for a massive deep dive. Because when you look at this Q2 data, your immediate instinct is to, search for a fatal flaw.
Sure, you look for the cracks.
Right. You assume that if a CEO opens an earnings call with a mea culpa, the core engine must be sputtering.
But that's the thing. We need to dig into the actual mechanisms here, the how and the why behind the data.
Because once we translate this specific, highly technical ad tech jargon, it actually reveals a radically different reality. So if you're holding the stock or thinking about it, stick with us.
Yeah, we're going to deconstruct the mechanics of their artificial intelligence, explore how they are bridging the gap between mobile gaming and global e-commerce.
Which is huge.
It is. And ultimately, we're going to determine whether this supposed miss is actually, one of the most compelling bullish setups in the market today.
The discrepancy between the headline narrative and the underlying financial health is just striking.
Extremely.
So let's just start with the headline numbers. We have to set the baseline of what a, quote unquote, disappointing quarter looks like for Applovin.
Right. Let's look at the data.
For the second quarter ending June 30th, 2026, the company reported revenue of $1.92 billion.
$1.92 billion.
Yeah. That is a multi-billion-dollar run rate. It represents 53% growth year over year.
Which is massive.
And crucially, it's also up 4% sequentially from the first quarter.
And, that sequential growth metric is often overlooked, but it is vital for evaluating software platforms.
Why is that?
Well, year over year growth tells you if the business is larger than it was a year ago, right?
Right.
But sequential growth, so comparing Q2 to the immediately preceding Q1, that tells you if the momentum is stalling right now.
Oh, I see.
Yeah, so maintaining a 4% quarter-over-quarter expansion on a base this massive, it proves the flywheel is still spinning, despite, what management's tone might have suggested.
Right. And we aren't just talking about top-line vanity revenue here, where a company just buys growth at the expense of profitability.
No, not at all.
The efficiency metrics are what really jump off the page for me. Let's look at their adjusted EBITDA.
Yeah, let's talk about that.
Which, for anyone listening, is essentially their cash profit from operations before the accountants step in to calculate taxes and depreciation.
The hard cash.
Exactly. That number came in at $1.61 billion.
Which is a 58% increase from the same period last year.
58%.
Notice that the profit growth outpaced the revenue growth.
Yeah, let's define the mechanism behind that, because they noted their margins expanded by 300 basis points compared to last year.
Right.
And again, for anyone not steeped in finance terminology, 300 basis points simply means their profit margin grew by an extra 3%.
Which is a huge jump at that scale.
It is, and that brings their total adjusted EBITDA margin to roughly 83%.
83%?
I really need us to pause on that number, 83%. Like, if you are manufacturing cars or selling retail clothing, keeping 10 or 15 cents of profit on $1 of revenue is a massive victory.
Oh yeah, you're thrilled with 15 cents.
Applovin is keeping 83 cents on the dollar. How does a business physically achieve that kind of operating leverage?
Well, you have to look at the molecular structure of an AI-driven software platform.
Okay.
When a traditional business wants to double its revenue, it has to, double its real estate footprint, double its supply chain logistics.
Hire twice as many people.
Yeah. Exactly. Double its headcount. The costs rise in tandem with the revenue. But Applovin operates in a completely different physical reality.
Because it's all software.
Right. Their primary asset is a predictive algorithm. It's a mathematical model housed on servers. So when they add a new advertiser to their network who decides to spend, let's say, $10 million, Applovin doesn't have to build a new factory to process that spend.
The infrastructure is already built and paid for.
Exactly. The pipes are already laid. So as more ad dollars flow through those digital pipes, the incremental cost to Applovin to route those dollars is practically zero.
Wow.
Aside from server compute costs, which I know we will analyze heavily later.
Oh, we definitely will.
But yeah, the vast majority of that gross revenue drops straight to the bottom line as pure profit. That is the magic of software operating leverage.
And it's how you print $863 million in free cash flow in a single 90-day period.
It's just staggering cash generation.
Which brings us back to the central paradox here. The CEO, Adam Ferughi, gets on the call and explicitly states, quote, "This was just below the midpoint of our guidance range, and our adjusted EBITDA was just below the range."
Right.
And then he followed that up by saying, "This quarter, we fell short of that standard."
Yeah, it's pretty blunt.
I look at those numbers and I look at that quote and I have to ask, is this just corporate theater?
You think it's performative?
It feels highly performative. By issuing a public apology for 53% growth, aren't they just artificially establishing themselves as the most demanding management team in Silicon Valley? Like, wait, they grew by over 50% and missed their own target? That's like getting an A- on a test and grounding yourself.
I get that. But I'll actually take the other side of that argument.
Really?
Yeah, it might feel severe, but management credibility is the single most valuable currency a public company holds.
Okay.
Especially in the current macroeconomic environment. What's fascinating here is how they handle it. Think about the alternatives. Right now, it is incredibly common, almost expected, really, for a tech CEO to blame a slight miss on external factors.
Oh, totally. They cite inflation, consumer spending pullbacks.
Geopolitical uncertainty, you name it.
They use the economy as a shield.
They do. But doing so sends a terrifying subconscious signal to investors.
How so?
It tells the market that the company's business model is vulnerable to forces outside of its control.
Ah, I see.
Applovin took extreme ownership instead. The CEO stated definitively that the macro environment is fine, advertiser demand is robust, and the slight miss was entirely due to their own internal execution timeline regarding a software update.
So by taking the blame, they paradoxically proved the strength of their moat.
Exactly. They signaled that nothing is wrong with the market. They just missed an internal deadline by a matter of days.
Okay, let's dig into the anatomy of that specific deadline. Because to understand the miss, we have to understand the core engine of their revenue.
Right. The model performance.
I need to translate that concept, yeah.
Yeah.
The majority of that, nearly $2 billion in revenue, stems from mobile gaming.
Correct.
Game developers pay Applovin to acquire new high-value players. And the lever that controls how much money those developers spend is what management repeatedly referred to as ROAS.
Return on ad spend.
Right. Walk us through a simulated millisecond in the life of this algorithm. Like, how does model performance dictate ROAS?
Okay, picture the Applovin AI as a hyper-intelligent, invisible commodities broker.
Okay, I'm picturing it.
On one side of the transaction, you have a mobile game developer.
Right.
Let's say they built a new puzzle game.
Love a good puzzle game.
Right. So they tell Applov, I am willing to pay for advertising, but I require strict mathematical certainty. For every dollar I give you to show ads, I need the user you acquire for me to eventually spend $1.70 in my game on extra lives or digital gems.
Okay, so that is their target ROAS.
Yes.
So the advertiser establishes a hard mathematical floor. If Applovin can't hit that metric, the advertiser pulls the budget.
Exactly. And that is where the predictive model takes over.
Okay.
When a person sitting on their couch opens a generic weather app or a casual game, there's a fraction of a second available to show them an ad.
Just a millisecond.
In that millisecond, Applovin's algorithm evaluates billions of historical data points. It looks at the time of day, the specific device type, and the historical swipe and purchase patterns associated with similar anonymized profiles.
Wow.
The AI calculates the exact probability that this specific person will not only click the ad for the puzzle game, but actually pull out their credit card to buy extra lives 2 weeks from now.
That is wild. So when management talks about, quote, meaningful model improvements, they're talking about software engineers tweaking the math so the AI gets better at predicting the future.
Precisely. When the model gets smarter, it suddenly finds higher quality users for a cheaper price. So the puzzle game developer wakes up, checks their dashboard, and sees that their return on ad spend has jumped from $1.20 to $1.50.
And then human psychology takes over.
Oh, absolutely.
Because if you have a machine where you insert $1 and it spits out $1.50, you don't just keep inserting single dollars, you back up a truck and empty your bank account into the machine.
The budgets scale up programmatically.
Right.
The advertisers aren't calling Applovin sales reps to negotiate higher tiers. The software simply removes the budget caps because the return is guaranteed.
So the better the AI predicts human behavior, the more efficiently it allocates ad inventory.
And the more total capital the advertisers allow Applovin to deploy. The lifeblood of their quarterly revenue growth isn't a bloated sales team.
It's the continuous release of upgrades to this predictive model.
Exactly.
Which isolates the Q2 hiccup perfectly, because the CEO explained that the pace of these model improvements was lighter than normal during the quarter. Mm-hmm. And this is where I think a lot of financial analysts misunderstand the nature of software engineering.
They definitely do.
Because they model R&D as a linear factory line. You put in 1,000 hours of coding, you get a 5% revenue bump.
Right.
But that's not how machine learning works at all.
It is the exact opposite of a factory line. The CEO detailed that their system relies on relentless A/B testing.
Right.
They run thousands of tiny, simultaneous experiments on the algorithm.
I look at it almost like a genetic mutation in biology.
That's a great way to put it.
Yeah, like the engineering team introduces random variations into the code. Most of those mutations do nothing.
Or they're worse.
Right. Some of them actually hurt the model's accuracy, and those are immediately discarded. But you are constantly running these tests, waiting for the one random combination, the super mutant, that suddenly increases prediction accuracy by a massive margin.
That analogy captures the volatility of the process perfectly. You just can't schedule a breakthrough.
You can't put it on a calendar.
No. You can have a 3-week period where every single A/B test yields a dud. And then on a Tuesday afternoon, a tweak to a single neural network layer suddenly unlocks a 10% jump in ROAS.
So what happened to Applovin in Q2 is that the timeline of those successful mutations just didn't line up neatly with the 90-day accounting calendar mandated by the SEC.
Exactly. It's like waiting for a major smartphone OS update. But the developers pushed the release date back by 3 weeks.
Right. The fiscal quarter ended on June 30th. If the algorithm breakthrough happens on July 5th,
Wall Street algorithms register a revenue miss.
Even though the fundamental technology just took a massive leap forward.
Yeah. And the crucial takeaway for anyone holding this stock is that the upgrade did happen.
It wasn't a failure, it was just late.
Right. The CEO was emphatic that the next major step up in model performance landed just after the quarter closed. It's live right now.
Wow.
Furthermore, they confirmed zero weakening in the overall advertiser demand. The competitive landscape didn't shift in favor of Arrival.
So it was purely a matter of the software code deployment spindle missing an arbitrary financial deadline by a few days.
Literally a few days.
Okay, so we have established that the core gaming business is fundamentally intact despite the deployment delay.
Very much intact.
But I want to pivot now because focusing entirely on mobile gaming misses what I consider the most explosive revelation of this entire earnings call.
The e-commerce expansion.
Yes. We need to dissect their consumer business. Because this is the narrative that takes Applovin from a niche gaming utility to a structural threat to the biggest advertising platforms on earth.
The e-commerce initiative is the holy grail for them.
It has to be.
Historically, Applovin has operated within the walled garden of mobile games. But recently, they made the decision to point this incredibly lethal predictive AI away from digital puzzle games and toward physical consumer products.
Clothing, electronics, cosmetics.
Exactly.
Let's lay out the specific data point management dropped, because it requires some serious retail context to appreciate.
Yeah, let's look at it.
They noted that advertiser spend in this new consumer vertical set another record, finishing 28% above Q4 2025 levels.
28%.
Now, for anyone outside the retail industry, comparing Q2 to Q4 might sound like arbitrary corporate trivia. Break down the retail seasonality calendar for us. Why is a Q2 beat over Q4 mathematically staggering?
Well, in the world of e-commerce, the fourth quarter, so encompassing October, November, and December, is the undisputed apex of the year.
Oh.
It holds Black Friday, Cyber Monday, and the entire holiday shopping sprint. Consumer intent to purchase is at its absolute maximum,
Right.
which means e-commerce brands dedicate the vast majority of their annual marketing budgets to Q4. They will pay exorbitant rates for ad space because the conversion rates are guaranteed by holiday demand.
It's a total feeding frenzy. But Q2, April, May, and June is the opposite.
Q2 is notoriously the slowest and most stagnant season for consumer retail advertising.
Right. The weather gets warm, people go outside, and nobody is panic buying a sweater or a coffee machine in mid-May.
Exactly. Advertising budgets typically plummet as brands conserve cash for the back half of the year.
Okay.
Therefore, for Applovin to report that their e-commerce ad revenue in the sluggish second quarter was 28% higher than their peak holiday season.
It's insane.
It demonstrates an adoption curve that is practically vertical.
It tells you that the brands using the platform aren't just testing the waters.
No, they're fully in.
The returns they are seeing are so undeniably lucrative that they are ignoring retail seasonality entirely and scaling their budgets aggressively just to capture the ROI.
Right. They recently opened this capability to the public under the banner of Applovin Ads Manager.
Okay, I saw that.
But management was remarkably disciplined in how they discussed the rollout. They aren't attempting to boil the ocean on day one.
Which is smart.
Very smart.
Yeah.
They are deliberately targeting a very specific slice of the mid-market brands.
This strategy fascinated me because an analyst pressed them during the Q&A session asking why Applovin doesn't just immediately target Fortune 500 titans like Nike or open the floodgates to every single mom and pop Shopify store operating out of a garage.
Right. Why not go after everyone?
Exactly. And the CEO's explanation centered around a concept called the learning budget.
Yes.
I want to spend significant time on this because it explains the fundamental difference between legacy advertising and AI advertising. Walk us through a simulation. Let's say I launch a mid-market artisanal coffee brand and I have $5,000 to spend on Applovin. What happens on day one?
Well, on day one, the Applovin AI is operating in the dark regarding your specific coffee brand.
Okay.
Contrast this with mobile gaming. If you launch a new digital slot machine game, Applovin's AI instantly knows exactly which users to target because it has 14 years of historical data on mobile casino players.
So it hits your ROAS targets within minutes.
Exactly.
Yeah.
But the AI has no historical context for your artisanal coffee. It doesn't know if your ideal customer is a 20-year-old college student in Boston or a 50-year-old executive in Seattle.
It's starting from scratch.
Therefore, the algorithm must experiment. It takes a portion of your $5,000 budget and begins showing ads to a wide array of demographics.
It's throwing spaghetti at the wall.
Basically, it serves impressions to teenagers, retirees, rural users, and urban professionals. It monitors the data flow, who scrolls past, who pauses, who clicks, and crucially, who actually completes the checkout process.
Right.
This experimentation phase inevitably results in wasted ad spend because the AI is purchasing data to map the territory.
Okay, I see.
That initial capital required to train the model on a specific product is the learning budget.
And this is exactly why the mom and pop shops are a terrible target market for Applovin right now.
Yes, exactly.
Because if a garage-based entrepreneur only has $500 total to their name, and the AI spends all $500 on day one just figuring out who does not want to buy the product.
That entrepreneur churns.
Right. They cancel their account, declare the platform a failure, and never come back. The AI never gets the time or the capital it needs to actually optimize.
That dynamic is fatal to a nascent ad platform. Conversely, mid-market brands are sophisticated enough to understand the cost of data acquisition.
They have real budgets.
Right. They have marketing budgets in the tens or hundreds of thousands of dollars. They expect the first week of a campaign to be inefficient. They are willing to float the learning budget.
And once the AI absorbs enough data to identify the exact archetype of the coffee buyer, it locks in.
The ROAS flips from negative to wildly positive.
And once that mathematical floor is established, the mid-market brand sets their budget to unlimited.
Exactly. By aggressively targeting this specific tier of companies, Applovin secures reliable, sticky revenue while effectively getting these brands to subsidize the training of the e-commerce AI model.
It is a masterful sequencing strategy.
It really is.
But they still face a massive hurdle in brand awareness. I mean, outside of the insular mobile gaming developer community, the average chief marketing officer of an e-commerce brand has never heard of Applovin.
No, probably not.
Their default setting is to just divide their budget between Meta and Google.
The duopoly.
Right. How does Applovin break that duopoly conditioning?
Well, they're executing end-arounds via strategic partnerships with the analytics platforms these brands already trust. Management highlighted a partnership with a company called Triple Whale.
Yeah, I saw that. And for context, Triple Whale is a centralized data dashboard that thousands of e-commerce brands use to track where their sales are actually coming from, independent of what Facebook or Google claims.
It's a source of truth for them.
Exactly.
So when an e-commerce CMO logs into their Triple Whale dashboard and consistently sees a tiny sliver of their budget allocated to Applovin, generating double or triple return of their massive Meta budget, the data speaks for itself.
The numbers don't lie.
Right. The partnership turns the analytics provider into a powerful, objective referral engine, completely bypassing the need for Applovin to spend billions on traditional B2B marketing.
The data integration solves the awareness problem.
It does.
But during the call, management admitted to a much more difficult structural problem. We need to talk about the creative bottleneck.
Oh, yes.
Because if I am that coffee brand and I want to run an ad on Instagram, I can take a high-resolution photo of my coffee bag on my kitchen counter, type 3 lines of text, and have a live ad campaign in 4 minutes.
The friction is almost zero.
Right, it's zero. But Applovin's network is built inside mobile games. You can't just show a static photo of a coffee bag between levels of a racing game.
No, it would look completely out of place. The architecture of mobile gaming inventory demands highly immersive 30 to 60 second full-screen video assets.
It has to be dynamic.
More specifically, the industry standard relies heavily on interactive end cards or playable ads.
Oh, I have experienced these. You finish a level of Sudoku, an ad takes over the screen, and you are suddenly presented with a playable minigame.
Right.
You can physically swipe the screen to solve a puzzle or shoot a basketball before the ad directs you to the App Store.
And they are incredibly engaging, which is why the conversion rates are so high.
But how on earth does a mid-market coffee brand build a playable video game ad for a physical bag of beans?
Well, they don't.
Right.
Most consumer brands lack the in-house engineering and high-end video production teams required to build those assets.
It's too expensive.
Way too expensive.
Yeah.
And management was incredibly transparent about this friction point. They have built generative AI tools that can automatically stitch together the interactive end cards. So allowing a user to perhaps swipe to spin a 3D model of the product.
Okay, that's cool.
However, they flatly admitted they have not yet cracked the code on fully automating the creation of the core, high-quality 30-second video itself.
Think about the computational complexity of what they are trying to achieve there.
It's massive.
They want a CMO to be able to drop a simple product URL into the Applovin Ads Manager and have an AI instantly scrape the website, generate a compelling script, synthesize a voiceover, and render a flawless 30-second video commercial that doesn't suffer from AI hallucinations.
It is a monumental computer science challenge. Video generation is just computationally brutal. But the CEO noted that this is the primary bottleneck preventing mass adoption.
Once their engineering teams solve this, once they can offer true one-click campaign creation that matches the low friction of Meta, the conversion rate of new advertisers onboarding to the platform will likely go parabolic.
Oh, absolutely.
But the fact that they haven't cracked automated video generation yet brings up a massive question about capital allocation.
Right. How much are they spending on it?
If this is the known bottleneck preventing explosive e-commerce growth, how much money are they actually throwing at their engineering teams to fix it? And that logical thread leads us directly into Section 3 of our deep dive: management guidance and the deeply scrutinized topic of compute costs.
Right. The guidance for Q3 provides the ultimate validation that the Q2 delay was a transient event. The CFO, Matt Stumpf, laid out a forecast that leaves no room for ambiguity regarding the health of the core business.
Okay, let's put the Q3 numbers on the table.
Let's do it.
They are guiding for revenue between $2.05 billion and $2.085 billion.
So over $2 billion again.
Yeah. That represents 46 to 48% year-over-year growth. And more importantly, it's a massive 7 to 8% jump sequentially from Q2.
There's that sequential growth again.
Right. And they expect adjusted EBITDA to land between $1.71 billion and $1.74 billion, maintaining that pristine 83% margin.
And you have to understand, this forecast is not based on hope or theoretical future software updates.
It's grounded in reality.
The CFO explicitly stated that this guidance reflects the impact of the model improvements that are already live and functioning in the market today.
The business, in management's own words, is, quote, re-accelerating.
Yes. Yep. Furthermore, they clarify that this guidance does not assume any additional model releases that haven't been deployed yet.
Oh, wow. So if their R&D team pushes another successful genetic mutation to the algorithm in August or September,
that represents pure upside to these numbers.
But driving those upgrades requires immense server power. And this is where I'm going to push back hard on management's narrative.
Okay, let's hear it.
Because the phrase compute costs triggered alarm bells for me.
Sure.
During the call, they mentioned higher compute run rates and architectural changes.
Right.
Right now, across the tech sector, we are watching companies incinerate tens of billions of dollars buying NVIDIA chips and building data centers with zero clear path to a return on investment.
It's a bloodbath out there.
It is. So management claims they spend exactly 10 cents on compute for every incremental dollar of revenue they generate. But how can they possibly guarantee that ratio stays flat? Aren't they entirely at the mercy of hardware providers? If NVIDIA doubles the price of GPUs or AWS raises cloud hosting rates, doesn't that 10-cent ratio get blown to pieces?
It is the most critical risk factor to analyze in the AI era, for sure.
Well,
but Applovin's defense against hardware extortion is rooted in how they deploy their models.
Okay, explain that.
You have to separate the concept of training in AI from inferencing in AI.
Okay.
Companies bleeding cash right now are spending billions training massive generalized foundational models from scratch, hoping to invent artificial general intelligence.
Like OpenAI.
Exactly. Applovin is doing applied machine learning. They are running highly specific inference models optimized for a singular task, predicting ad clicks.
So they aren't trying to build a chatbot that can write a novel and pass the bar exam.
No.
They're just calculating math probabilities.
Exactly. And the architectural changes management mentioned involve optimizing their software to run more efficiently on existing hardware rather than just brute forcing the problem by buying more expensive chips.
Yeah, that makes sense.
Furthermore, their capital deployment is strictly tied to empirical results. They do not buy server capacity on speculation.
They wait for proof.
They only scale up the compute spend when an A/B test definitively proves that a more complex, computationally heavy model yields a disproportionate increase in ROAS for the advertiser.
Which immediately translates to higher revenue for Applovin.
Exactly.
The CFO made a statement that perfectly encapsulated their philosophy. He said, quote, "We manage this business to EBITDA dollars and free cash flow rather than to a margin percentage, and will continue to deploy dollars when we see an opportunity to produce more revenue."
That is a crucial quote.
I really want to unpack the nuance of that because it's a masterclass in capital allocation.
It really is.
They are stating on the record that they would rather own 80% of a gargantuan pie than 85% of a medium-sized pie.
Consider the alternative. A management team obsessed purely with maintaining an 85% margin percentage might refuse to spend an extra $20 million on cloud computing.
Right, because it hurts the percentage.
Right. But if that $20 million in compute could generate an extra $150 million in top-line revenue, refusing the spend is fiscal malpractice.
Wow, yeah.
Yes, your overall margin percentage might tick down a fraction of a percent because your absolute costs increased, but your actual cash profit, your EBITDA dollars, just increased by $130 million.
As an investor, you take that trade every single day of the week.
Every day.
You cannot deposit a percentage into a bank account. You can only deposit dollars.
Exactly.
As long as that 10 cent to the dollar mathematical law holds true, retail investors should actively root for Applovin's compute costs to skyrocket because it guarantees an avalanche of top-line revenue.
And speaking of cash deposits, we must address a slight anomaly in the Q2 free cash flow.
Yeah, let's talk about that.
They generated $863 million, but the conversion rate from EBITDA was lower than their historical average.
Why was that?
The CFO was quick to clarify this was a transient timing dynamic related to international cash tax payments and interest schedules.
Oh, okay. Just accounting timing.
Right. He guided that the free cash flow conversion will normalize to roughly 75% for the full year.
Turning 75% of $1.7 billion in EBITDA into hard, unencumbered cash every 90 days is a financial reality most companies can't even comprehend.
It's phenomenal.
And while we are discussing the removal of uncertainty, we have to formally bury a storyline that has been haunting the stock, the SEC inquiry.
Oh yes, the ultimate regulatory overhang has been dissolved.
For those who haven't tracked the daily news flow, it surfaced months ago that the Securities and Exchange Commission had requested information from Applovin.
Right.
In the public markets, whenever the letters SEC appear adjacent to a stock ticker, institutional algorithms automatically sell and retail investors freeze.
Panic ensues.
The market will price in regulatory doom regardless of the underlying business fundamentals.
It artificially depresses the multiple of the stock.
Exactly. But the CFO closed the loop on this definitively during the call.
What did he say?
He stated the request was entirely voluntary, management never deemed it material enough to threaten the business, and most importantly, the SEC recently advised them that the inquiry is officially concluded with zero recommended action.
Zero action.
The file is closed. The regulatory discount on the stock should theoretically evaporate immediately.
Which brings us to the synthesis of all this data. We have arrived at the bottom line.
Section 4.
Right. If an investor is evaluating the Applovin ticker today, attempting to reconcile the CEO's apology with the 53% revenue growth, how do we translate this into an actionable verdict?
The verdict, when you strip away the conversational tone of the earnings call and focus purely on the mechanics and the math, is overwhelmingly bullish.
Highly bullish.
If you hold the stock or are evaluating a position, the defense for that bullishness is built on an impenetrable fortress of financial metrics. Let's start with the balance sheet, because this company is operating with a level of financial invulnerability that is rare in high-growth tech.
Very rare. They ended the second quarter with $3.05 billion in cash and equivalents against $3.7 billion in total debt.
Which means their net debt is practically a rounding error relative to their earning power.
Basically, yeah.
The CFO noted their net leverage is approximately 0.1 times trailing 12-month adjusted EBITDA. And for clarity, trailing 12-month EBITDA just means looking at the total cash profit they generated over the past entire year.
Right. And operating at 0.1 times leverage means they could practically eliminate their entire corporate debt load using just the cash sitting in their bank accounts and a single quarter of future cash flow.
That is absurd.
Compare that to legacy media companies or telecommunications giants that operate at 4 or 5 times leverage, sweating profusely over every single interest rate hike by the Federal Reserve.
Oh, man, yeah.
Applovin is entirely insulated from credit market volatility. They operate so far below their own internal 1 times leverage target that they have a massive surplus of capital with no internal fires to extinguish.
And what does a highly competent management team do when they have billions in excess cash and absolute conviction that the market is undervaluing their AI model?
They buy back stock.
They execute share buybacks with ruthless aggression.
Ruthless.
During the second quarter alone, they repurchased and withheld 1.14 million shares, deploying $551 million of capital.
That's $500 million in 1 quarter.
And they still possess approximately $1.8 billion remaining under their board-approved share repurchase authorization.
The mathematics of share buybacks are a critical concept for investors to internalize.
Let's bring it down.
When Applovin takes $551 million into the open market and buys its own stock, it retires those shares. It permanently removes them from existence. Imagine the company's future profits as a pizza cut into 100 slices. If management buys back and destroys 10 slices, the pizza itself didn't shrink. The profits are still the same, but now the whole pie is divided into only 90 slices.
Therefore, every single remaining slice, every share held by you, the retail investor suddenly represents a mathematically larger percentage of ownership in the company's total earnings.
Exactly. It artificially forces the earnings per share metric upward, which historically acts as a relentless gravitational pull on the stock price over the long term.
Management did note they moderated the pace of the buyback slightly in Q2 due to the aforementioned tax timing payments, but they explicitly communicated this does not signal a lack of conviction.
Right. They intend to continue aggressively retiring shares.
This is the ultimate insider signal.
It really is.
If the executive team believed the e-commerce expansion was failing or that the AI model had hit a permanent plateau, they would hoard their cash to protect the downside.
But instead, they are systematically devouring their own float,
telegraphing to Wall Street that they believe their own shares are severely mispriced.
So when you aggregate the entire narrative, the picture is stunning. You have a company expanding top-line revenue at over 50%, printing 83% profit margins, carrying effectively zero net leverage, aggressively reducing its share count,
and presiding over a predictive AI model that has successfully broken out of the mobile gaming ecosystem and is currently setting records in the massive, untapped ocean of global e-commerce.
The multi-year trajectory is what matters here. As the CEO pointed out, it took them 14 brutal years of iteration to become the de facto standard in mobile gaming.
14 years.
To reach a point where any game developer on Earth would be committing professional malpractice by not allocating budget to Applovin's platform.
Right.
They are now applying that exact same battle-tested algorithmic playbook to consumer retail.
But they are doing it with a fundamentally superior, vastly more evolved AI architecture.
The runway for mid-market brand adoption is immense, especially as the cost of acquiring customers on legacy platforms like Facebook and Google continues to rise. E-commerce advertisers are desperate for an alternative that delivers mathematical certainty.
The bottom line is that the foundational mechanics of the business are flawless. The machine is learning faster, the addressable market is expanding by orders of magnitude, and the cash generation engine is operating at peak efficiency.
Yeah.
If an investor can look past the superficial narrative of a 3-day delay in a software deployment missing a calendar deadline, the underlying reality is one of the most dominant operational performances in the software sector.
It serves as a textbook reminder that true alpha is generated by reading the transcripts, understanding the engineering mechanics, and ignoring the emotional headlines.
Exactly. Now, before we wrap up this deep dive, we always want to leave you with a final provocative thread to pull on something that stretches beyond the immediate quarterly numbers and hints at the long-term structural disruption this company might cause.
And the catalyst for that disruption was briefly teased at the very end of the Q&A session by an analyst inquiring about connected TV or CTV.
Yes. Throughout this entire analysis, we have been exclusively discussing mobile phones. We are talking about algorithms optimizing ads for 6-inch screens.
Okay.
Applovin has conquered the mobile gaming space. They are currently proving they can capture mid-market e-commerce transactions on those same mobile devices. But the CEO openly acknowledged that the ultimate frontier for their ad network supply is the living room.
Television advertising is undergoing a violent structural shift. Budgets are draining out of traditional linear broadcast and flooding into performance-based streaming platforms.
Roku, Amazon Fire, Hulu.
Exactly. This is a multi-billion-dollar arena that is utterly desperate for the kind of granular, deterministic attribution tracking that Applovin has perfected in the mobile ecosystem.
Because traditional TV ads rely on fuzzy metrics like brand lift and estimated impressions.
All right, it's all guesswork.
Imagine the implications of applying Applovin's hyperlegal AI to that environment.
It would be staggering.
If their predictive model is sophisticated enough to accurately calculate the probability that a mobile gamer will stop playing Sudoku to buy a $50 bag of coffee with one click on a tiny screen, well, what happens to the entire global advertising industry when Applovin's algorithm starts powering the commercials on your 65-inch television while you watch a live sporting event?
It's a huge question. Management was clear they aren't deploying this aggressively yet. They stated they are currently budgetarily constrained simply by the sheer, overwhelming volume of demand they're seeing on mobile right now.
Good problem to have.
Right. They don't need the living room today,
Yeah.
but it is definitively on the roadmap. When that mathematical certainty makes the leap from the phone in your hand to the largest screen in your house, the disruption to traditional advertising agencies will be absolute.
It changes the entire paradigm of how products are sold. Keep an eye on how quickly they solve that video generation bottleneck, because that is the key that unlocks the living room. Well, thank you for joining us on this Talk Tickers edition of our deep dive into Applovin's Q2 earnings. We hope we've helped translate the jargon, clarify the mechanics, and clear the murky waters of Wall Street expectations.
It was a pleasure.
Remember, when management apologizes for a massive beat, don't just look at the headline, look at the algorithm. Review your portfolios, stay insanely curious about the mechanics of the businesses you own, and we'll see you on the next deep dive.